Hi everyone, welcome to episode 4 of this Learn on the Go series. And today we'll tackle one of the biggest questions in investing, how to find multi-bagger stocks. Now, I'm sure many of us would have built something or the other on a screening platform. I think it's a solid approach. It's a great way to start. And I won't be doing anything different from that. I'll just try and improve things a bit by doing reverse engineering, and let's see how that works. The number I feel most comfortable with is the EPS. And that's because if the EPS is growing, generally the stock price follows suit. Actually, let me show you something. So let's go to trendline.com. Let's go to Nifty 50. We have Nifty 50 EPS. Yeah, and look at this graph here. So the pink line, it represents the Nifty 50 EPS value, and the green line represents the actual Nifty. Okay. When you look at it over a 1 year period, there is hardly any kind of pattern that you can figure out. It seems like two random lines. But if I click on all, now look at this. The pink line and the green line, it looks like mirror images of each other. There are certain periods where the pink line dominates the green line, but there are periods where the green line dominates the pink one. And these are basically periods of over and under valuation. But generally, if you look at it as a trend, you'll see that they kind of follow the same path. And that's exactly what I'm trying to explain here, that the Nifty is nothing but a slave to the Nifty EPS. So if the EPS is increasing, you'll generally see that the Nifty is also increasing and vice versa. How is this important for us? Let's go to Screener. And because we're trying to do reverse engineering, let's try this here. Okay, EPS growth of, let's say, the last 10 years is at least 25.9%. Why 25.9? Very simple. Let's say the definition of a multi-bagger for us is 10x. So 1 rupee becomes 10 rupees in the next 10 years. And what's the compounding that's required to get there? It's 25.9. Let me just show it on Google itself. 1.259 raised power 10 comes to 10.00. So if you have 1 rupee and you can compound it by 25.9% over the next 10 years, then your 1 rupee becomes 10 rupees. So that's what we're trying to achieve here. This is basically our definition of multi-bagger. And let's go back to the stock screener and complete this entire thing. So we're looking for EPS growth of over a 10-year period of 25.9. If I were to just go with this definition, there are like 424 results. That's 424 companies that have grown their EPS by 25.9% over these last 10 years. This number is a bit too high. And secondly, this can also be a fluke. You never know when this EPS growth has happened. It might have happened in the last 2 years for all I know. Suddenly there's a stock which had done nothing for 8 years. And suddenly in the last 2 years, it was able to grow its EPS from 1 rupee to 10 rupees or something like that, right? But we want a bit more consistency. So let's kind of expand this thing a bit. And let's say over different periods of time, we are looking for an EPS growth of 25.9 throughout. Okay, so I'll keep it till EPS growth, a 3-year CAGR of 25.9. Let's not do the last 1 year because sometimes, things go up and down. But 3, 5, 7, and 10 are good periods for us to consider. And we are now down to 154 results, which is still a good number, right? 154 companies that have given us 25.9% in terms of EPS growth. Let's quickly sort it by the market cap. And, one of the first things I want you to look at is let's match this EPS growth with the stock price returns that has happened over these last 10 years. Remember, I'm trying to connect it back to that Nifty 50 chart which I showed you, that as the EPS has grown, so has the Nifty value. So let's see if that's applicable here as well. So look at the first example trend, a very good example to have. The EPS has grown by 46.9% while the stock price has grown by 46.4%. So it's an absolute match. Lloyd's Metal, not exactly the same. Autumn investments, so 147 versus 125, pretty close. 31 versus 36, 25 versus 27, 38, 42. So generally, it seems to be working. I was looking at the other entries also. Again, very, very similar stuff. So kind of firmly establishes that as the EPS grows, so does the stock price. Okay, now that we are here, let's look at some other variables as well. Let's look at the sales growth, and we generally see that most of these companies, which by our definition are multibaggers, they have grown their sales by an average of around 15%. Profits have obviously grown a lot higher than that number. The bare minimum that I can see here is at least 25.9% because that's what we had kind of put in. The ROCE, again, the current ROCE, okay, this is, so I've taken both. I've taken the ROCE and I've taken the average ROCE over the last 10 years. So one can see that generally all these companies seem to have upwards of 25, at least 20%, but generally seems to be an average of around 30%. Promoter holding is high. This will mostly be the case. In India, generally, for most of the mid caps and the small cap companies, the promoter holdings is definitely over 50%. All right, so let's look beyond the screen. And remember, we wanted some level of consistency. So EPS growth of 10 years, 7 years, 5 years, and the 3-year CAGR. We want it to be above 25.9, which basically means that we want the EPS to be smooth and consistent. Let's see if that's happening. Let's pick some companies. Let's pick the top 3. Trent, Varun Beverages, and Dixon Technologies. Let's see if this is happening. So let's go to Trent. Let's look at the P ratio, the last 10 years. To some extent, yes, actually. These were the COVID years. So the EPS did go down because most of the shops were closed at that time. So Trent couldn't be doing much sales. But if you exclude this period, you can see there is a nice consistent growth in EPS that has happened over different quarters, which is exactly what we're looking at. We don't want companies that are inconsistent with their EPS growth. And this generally happens with cyclical companies or companies, which have suddenly had some good luck, or suddenly you see that there is some exceptional gain which has happened because they sold some real estate or something like that. That's not what we're looking for. We are definitely looking for consistent EPS growers. Let's look at Varun Beverages. And again, over a 10-year period, barring the COVID period where it went down, Varun Beverages has been showing a nice, consistent, very linear kind of a growth in EPS. Finally, let's look at Dixon Technologies. Over the last 10 years, started obviously very slow, and then it's kind of showing a nice parabolic kind of a jump in EPS. Again, very good. This is obviously something that we guys are looking for. Let's go back to the screener, and I want you to look at the market cap. So this column here, it represents the market cap of this particular company 10 years back. And this is where we are right now. So for a company like Trent, it was available, the entire company was available for less than 5,000 crores. It's now at almost 2 lakh crores. And you can see how it's been for different companies. And a cursory glance shows us that most of these companies were like very, very small players. I think all of them are less than 5,000. Let me just do a quick sort here and see. Yes, so all the companies were less than 5,000 10 years back, and these guys have become massive. So let's go with that definition. Let's kind of improve this query a bit, and let's say the current market cap, because we're trying to look for potential multibaggers. Let's say the current market cap should be less than 5,000. So these are the kind of companies that we are interested in. Let's run this query. It's down to 127. Let's look at the other stuff that we mentioned. Let's look at the sales growth, and we want companies which have at least a 15% sales growth, because if you aren't increasing your sales, then it's very unlikely that you'll be able to increase your profits. Let's factor this as well. So sales growth over 10 years has been at least 15%. On the query, we're now down to 73 companies. So remember, we're trying to stick entirely to the earnings part of things. Okay, so anything that has a very direct correlation to earnings, we are kind of sticking to that. I know market cap does have a valuation part to it, but the other stuff, which is sales growth, is definitely earnings related. EPS is also earnings related. And a couple more things I want to add here is there has to be some level of profitability at the moment, right? So let's have the operating profit and the net profit at least 10 crores. Okay, it's a small number, 10 crores. And I don't want to put more than this because there will be a bunch of companies here which will be small caps and nano caps and micro caps. So we don't want to kind of stretch this number too much at this stage, but let's see what it comes to. So you run this query and now you're down to 29. Okay, so this is much lower than the 430 odd companies that we started with. So let's do a quick recap. So what we have here are all microcap companies which have been in operation for at least 10 years. They've grown their EPS by at least 25.9% over the last 10 years. And even in recent years, their EPS growth has been pretty good. They've grown their revenue by 15% or more in these last 10 years. They're profitable with an EBITDA and a PAT of at least 10 crores. What else? The promoter holding has been at least 50% in most of these cases. And pleasantly, this comes more as a bonus for us. Presently, the P ratio for a bulk of these companies is less than 30. Now, I'm sure I've said it previously, but there's no harm in repeating it, that a screening platform should always be looked as a screener. What I mean is, it's more of a filter wherein you take a large universe of companies and then you break them down into more manageable proportions. So in this case, we started with some 450 odd companies. We are now down to 29. And you can add another layer of filtering on top of it. And in my case, it's basically my circle of competence. I'm not very good with finance companies. I don't understand that business too well for me to be comfortable with it. So from this 29, you can go on to industry and you can knock off any industry that you don't like. Most of them is fine except for finance and capital markets as well, right? So that's 7 plus 2. So that's 9 companies I've knocked off. And our shortlist is now down to just 20 odd companies, which is a lot more manageable. A parallel question is, how do you examine each of these companies? I think we've done that quite a number of times. But one thing you can do is to use this export to Excel feature that we learned in episode 1 of my Learn on the Go series. This is a very useful tool. Let's try it out. Okay. So so for Kingfa Sciences, let's look at the different elements. So I'll quickly go through it. So sales, for example, it's all going up except for this one COVID year where it went down, but otherwise it's up. Operating margins is also on the way up, 8, 9, 12, 13%. They've been paying taxes on time. Interest, so borrowing is not heavy. It's pretty low actually. And look at the net profit numbers, the PAT numbers. So from 5 in 2021, FY21 to 31, 81, 123 and 153. So yeah, so it's going well. I think in terms of red flags or yellow flags, the cash flow from operations isn't that good. If you look at it over the last 10 years, but over the last 4 years, yes, the cash flow from operations has been pretty decent, not as good as the net profits that they're generating. So this is probably something you might want to investigate. In fact, I'll have a video on cash flow from operations. I think a lot of people are getting it wrong when they examine it through Screener. I think a little more understanding of this would be required. And one place that they really lack is basically in the free cash flow department. So they aren't generating enough free cash flow. That's something that's visible from this sheet. So you can examine a lot of variables which are available here, but one variable in particular I want you to look at, and that's very relevant for today's video, is this one. So row 44, you have price to earnings, the P ratio. And what this worksheet has done here, it's mapped the P ratio across the last 10 years, which is very helpful for us. And you can see that as a chart within screener.in, but here it's more numerical, which is quite beneficial. So the 61.3 that you see here, this is the P ratio as on 31st of March 2016. Similarly, you have something for March of 2017, 18, 19, 20, and so on. Initially, it was pretty expensive, especially in the heydays of 2016 and 2017. And then things corrected for a while before COVID came in and kind of lopsided the numbers completely. But over the last 3 years, you can see that the P ratio has been consistently around the 20 mark. Now, 20 isn't a big number. It's a pretty reasonable number to have, but then you got to understand what's exactly this company into, what's the business model, what's the growth plans of this company, how they're allocating their capital, are they doing it prudently, etc. So there are a few questions you need to ask, but it does come because there's a shortlisted list. The good thing is that you have certain things working to your advantage. Number one, the EPS growth of the company has been consistent and sufficiently high, at least 25.9%. The sales growth has been more than 15%. In this case, I think it's a bit more. The net profits, it's a profitable company. Net profits are more than 10 crores. In this case, it's like 153 crores. So yeah, certain conditions have been passed through. The others you have to hunt around. In fact, let me stick to this price to earning thing. And what I've done is I have mapped this P ratio, not just for Kingfa Science, but I've actually done it for all companies. So all 20 companies, you can see the P ratio across different timelines, right from 2016 until March of 2025. And also what was the current P ratio? What's the current P ratio? This is as of 7th of July 2025. And this kind of gives you an idea. So let's again start with Kingfa only. And we see that March 2016, March 2017. By the way, this orange cell, so orange cell basically tells you what was the highest point of the P ratio across these 10 years. So in the case of Kingfa, it was March of 2017 when the company was valued at 75 times its net profits. So things have come down over time. So from 61.70, it has come down to now 29. Avantel was also pretty high during the 2016-17 period. It went down, but now it's again up to about 71. So maybe it's not that cheap at the moment. You can test it out for a lot of companies. Now, what I've also done is I've marked a few companies in green here. So look at this one, Jyoti Raisins. It's at a reasonable level, right, over the last 3 years. So 25, 20, 22 is the current P ratio. So maybe one can examine this. Similarly, RMC switchgears, it's at a reasonable level. Fredun Pharma, Geeky Wires, and Franklin. So these are even less than 20 in terms of P ratio. As I said, this is not enough. One has to examine a lot of things, but this at least gives you a little bit of happiness that when you enter into such companies, you aren't doing at an unreasonable valuation. So yeah, it's time to work more on this and do a bit more research on each of these companies. Yeah, I think this would be a good time for me to put in a disclaimer that whatever you and I have discussed today is purely academic. It's called the Learn on the Go series, not Earn on the Go series. So none of these are recommendations of any sort. But I do hope that what we have discussed today will spark a bit more curiosity in you in terms of you doing some follow-up, seeing how each of these companies align to your own thinking, and hopefully this improves your decision making as well. Now, we've done the growth bit, the earnings growth bit, and the valuation bit. And as far as I'm concerned, this is basically the bulk of what one needs when trying to identify potential multibaggers. I'm not saying that the other things don't matter. Debt to equity does matter, which we saw from that Mint article. Cash flows are important. We saw with the Kingfa case that cash flows were a bit lacking there. So you want to examine those things. Plus, there's growth, promoters, the quality of the management. There's any kind of government policies. What is the competitive advantage of a company? So while those other parts are also important, as far as I'm concerned, if you've covered the earnings growth part and the valuation bit, then you've covered quite a distance in your hunt for finding a potential multi-bagger. I'd like to end this video by reminding everyone that there is an element of survivorship bias in what we have done today. What is survivorship bias? Well, it's a scenario where we only focus on the winners, that is, companies, people, or cases that have survived a process while ignoring those that have failed or disappeared. Some Indian examples of companies that were very promising some 15 years back would include Suzlon, which was on a high in 2008, Unitech, which as of January 2008 was priced at 508 rupees, and now it's like 8 rupees, and also Educomp, which was India's largest edtech player there. The survivorship bias is very much there, and some of the things you can do to mitigate it would include building a portfolio rather than staking it out on 2 or 3 stocks. Do solid research, review your portfolio from time to time to see if your investment thesis is still valid. Avoid cyclical stocks, so commodities, real estate, it's better to avoid these, and do keep your expectations realistic. As I always say, everything is a probability, and a good multi-bagger strategy would involve careful selection, good conviction, strong risk management practices, and of course, periodic monitoring. I sincerely hope this video has been a little helpful to you in improving your own decision making as far as your own multi-bagger strategy is concerned. And if you have any questions for me, please drop them in the comments box below and I'll try to answer them to the extent I can. Once again, thank you for your time and I wish you the very best.